Hey everybody, Brian Shannon here from alphatrends.net. Today's Friday, the 9th of February, 2024, and we have a lot of new all-time highs in the market here. The S&P 500, the Nasdaq, the semis, and look at the semiconductors up close to 10% this week. A lot of people were calling that a double top. Hopefully you saw my video on Wednesday, and more important, if you follow me on Twitter, you'll see where it's all outlined. If you consider yourself a serious trader and you like my work and you're not following me on Twitter, you're making a big mistake because I give away a lot over there. And by the way, if you're watching on YouTube, please like it, subscribe it, share with your friends, etc. But just a super powerful week. The bonds lost a little bit of ground, as did energy, but that may change. So let's take a look in Bitcoin, which I've been narrating the whole way, had a huge week. The S&P 500, as mentioned, it's at a new all-time high. That's the most bullish thing a market can do. As I said on Wednesday, you can argue with the fact that we're up on lighter volume than some people would like to see. But the fact is, only price pays. We have seen volume diminish pretty much every single day, and this market continues to rally. You can talk about divergences that the MACD or the whatever isn't confirming. You can talk about the seasonality because February is supposed to be and typically is the weakest month of the year. But so far this year, that's not the case. And I like to keep it as simple as possible. And that means listen to price action because only price pays. The market continues to get stretched. It is extended on whatever time frame you really want to look at. And when we look at the two time frames, we gapped up high on Wednesday and we held above the anchor from that all, for the next 3 days. There's no point trying to fight this market. When we're above a rising 5-day moving average, that's the orange line, we don't want to fight the trend. It is innocent until proven guilty. That's not going to get you out at the top. But I hear a lot of people saying, oh, this is going to end badly. Well, guess what? It only ends badly for the people who don't have a plan for dealing with volatility. If you don't know where your stops are, and some of your highly appreciated stocks, then start to figure that out this weekend and realize that a reversal of some sort, or at least pullback, not necessarily a reversal, because this is a super strong trend above the 20-day moving average, 50-day moving average, 200-day. You look at the weekly time frame, it's above the 10, 20, 30, 40-week moving average. It's a super strong market. I'm not expecting a reversal. A pullback, maybe to the month-to-date volume-weighted average price down near 493. Sure, why not? But, that's not something that's going to shake out the long-term bulls in this market. We are in an uptrend. It is innocent until proven guilty. So don't be uneducated, money. Know where your stop is. Know where you want to get out and lock in your gains. Anyways, for the S&P, our first level of interest next week will be this high right here, and that is prior resistance, which is where we gapped up to, and that hopefully provides a little bit of support. Use the definition of trend, higher highs and higher lows above a rising 5-day moving average for an intermediate term trader for swing trades like myself, or maybe you're going to look at the 20-day moving average or the 50-day moving average. It depends on what your time frame is. This is something I outlined the other day saying, an inverse head and shoulders is supposed to be a reversal pattern, but it can be a continuation pattern as well. And this left shoulder, right shoulder, head and right shoulder occurred within this most recent consolidation above the rising 20-day moving average. So we had a little shakeout. That was it. Market got back to bullish and buyers are in control, continue to be in control. So the height of this pattern, and that's how we measure an approximate level of where it can go. Let's just call that 418 up to 429. We take that and we add it to the breakout point. So this is the breakout point. That means our projected upside, and I don't do price targets, but our projected upside would be at about 441.5. It doesn't mean I'm waiting for 441.5 to sell or I'm going to sell there. It's just a level of interest to help you kind of form your trade and say, is there enough room to buy the NASDAQ right here, right now? If this is the potential upside, where would my stop go? Maybe under here? Well, I can just eyeball it and see that I'm taking more risk than potential reward. So probably not. You have to look at it and say, where has it come from? Where does it have the potential to go before it's likely to encounter a source of supply that might become resistance? People talk about resistance levels. We don't know resistance until after the fact. There has been no resistance in this market. Semiconductors, as I mentioned, people were calling this a double top. I was very clear that it's not a double top until we break below this low right here. Otherwise, it's just a little pause at a level we've been at previously, and the market made a mockery of those people who were calling it a double top. What we saw on Tuesday rather, was we ran up to that level, we got all, and we pulled back a little bit. We got a lot of calls for a double top. And where did we come down to? We came right to the rising 5-day moving average, right to the month-to-date volume weighted average price. And then the next day, as it started to rally, we were off to the races again. What's wrong with buying here with a stop under there? That's the type of trade you should be looking for. And now raising your stop up underneath these successive higher lows. So what that would look like is maybe we get a little pullback on Monday, and then as soon as it starts to rally again, raise your stop under there. Until that pattern is broken, it's innocent till proven guilty. If it does something like this, well then on this time frame, that's your cue for getting out and taking your profits. It's just that simple, and people overcomplicate the market. The Russell 2000 is looking like, another reason to be bullish. Here, if we've spoken about the weekly chart and how this chart looks bullish. It is ready to get going, in my opinion. Here's the anchor from that high. We're well above it. We're above the anchor from this low. We're above a rising 10, 20, 30, 40-week moving average. This looks like it ought to be headed for a test of at least this prior band of support over in here, up near 212 to 215. Again, it's not a price target. It's a level of interest. It seems reasonable that it could go to, because there are people. Why does prior support tend to act as resistance? A lot of people were long in here. They didn't sell. Now, as it gets back up towards that level, they'll be looking to break even. As they look to break even, that creates supply. People who buy in here, and if it gets up to that level, they'll say, hey, there's likely supply there. Let's take some profits. It becomes a self-reinforcing level of resistance, or it might just blast through that level and continue to move higher. It's a level of interest that we can frame our trade around. That is, decide what's acceptable risk, and then maybe you got involved after I spoke about it Wednesday, saying the 5-day moving average would begin to rise, which it did on Thursday. We had spoken about it was getting rid of this data over here, and that would cause the 5-day moving average to rise. Well, that's exactly what we have. Now, what do we have? Well, we just broke out past this level right here. And the question is, where has it come from? We just rallied from 190 to 199. 5%. We just rallied 5% in the course of just as many days. Now, maybe it continues a little bit higher, but I don't really want to chase this. I have a little bit of exposure in this. I'd rather see it kind of do this. And again, the market doesn't care what I want. But if it's to do something like this next week, well, then I would set an anchor off of whatever this peak is, and I would observe that. I would look at this 5-day moving average coming up underneath it. I would look at the year-to-date anchor. I would look at the month-to-date anchor coming up under it. And then I would want to say, okay, now I want to be a buyer here with a stop under there. And then my target, I don't really have a target, but what would be a reasonable expectation for an intermediate term trade? Perhaps up towards this level, the prior peak at least, 205. So if I was to buy it at 198.50, looking to say maybe it goes to 205, that it would give us 7 points of upside and $1 of downside. That's a fantastic risk-reward ratio. Of course, it's all garbage. The market might just go to 198, shit the bed, and then that's the end of it. It ends up being a loss. Well, guess what? After it does that, it's not my problem. If I get stopped out with a small loss, that's called the initial protective stop. It means that we're not arrogant enough to think that we are going to be right and the market's going to agree with our assessment, but we make a reasonable expectation about what the market can do. We put our money on the line, but then we protect ourselves and say, well, if it goes down, great. I'm going to get out here because I don't want to continue to hold it. Here's a great example. I took 2 small losses in DOCU recently. I think I bought it on this day, took a small loss, bought it on this day, took a small loss, and that was like right here, take a loss, bought it here, took a small loss, and I didn't hold it through there. I took 2 small losses rather than continuing to hold and think I knew something about the company and watch it go from 62 down to 50. That doesn't make sense. What we want to do is say, If I'm wrong, I'm taking a small loss. If the market doesn't agree with my assessment, fine, so be it. I don't care what interest rates are doing. I know a lot of people are saying, well, IWM can't go higher because of interest rates. Well, it is. So who cares? You can't argue about theoretical relationships when you have price evidence right there in front of you telling you there are buyers of the IWM. Whatever academics want to tell you about why it shouldn't be going up, they can, teach a course in economics about why the market is wrong. But as a trader, I'm going to tell you trust price action in what you are trading and know where your stop is in case the market decides that interest rates are important for the Russell 2000. This is a bullish look. I would not be surprised at all to see in the next 3 to 6 months that we're up towards this level. Probably even sooner, but I like to be conservative and I'm not blinded by upside. I'm not going to talk about financials. I said I wasn't going to. Energy names, they pulled back a little bit today, still having trouble with that 200-day moving average. Last week we spoke about this possibly being a higher low if this market can get its act together. Let's take a look at oil. So here's oil on a weekly chart. Let me just frame this a little bit better so we have the 3 time frames. And then we're going to talk, of course, about Bitcoin and Ethereum. But this is the daily chart down here. So we've seen a nice little rally in oil recently. So maybe that will provide some buyers in the energy names. Here's Bitcoin. If you've been following me, you should be long. There's no reason not to be. We saw important things. This was the run up to this was the beginning of the move for the expectation of the ETF approval. This was the day of the ETF approval. We saw a sharp sell-off from there. It came down right to the anchor from the beginning of that move. As it moved higher, it had a little bit of trouble with this blue anchor, which is the year-to-date anchored VWAP. It got back above the anchor from this point, which was the average price since the ETF was approved. And then we broke higher right over here. And I've been mentioning it day in and day out. So I'm 100% long my Bitcoin allocation. What I'm going to do is take a third off when it breaks out past this $49,000 level. Once it breaks this prior peak right here, that's my cue to take a little bit of profit. Why? Because it's just had a run from 39,000 to 49,000. And then at that point, the people who are looking at it going, hey, it's a breakout, I got to buy. Well, guess what? They're late. You want to feed some liquidity to them after a 30% move. You don't want to be a buyer up there. You missed the bus. Don't worry about it. It'll pull back. It'll make a higher low, and then you can buy it again if you're not long already. But that's the way they work. Ethereum, I'm still long some of this. That's starting to act better as well. It's also above the year-to-date anchor and the anchor since the Bitcoin ETF approval. And it looks like this is probably going to 3,500, who knows? Bitcoin, to me, looks like 50,000 easy sometime in the near term. But going back to the stocks, we just are seeing stock after stock continue to move higher. Just know where you're going to protect your gains. Don't chase things. It has paid, I will admit, to chase some of these names. That will change, and when it does, some of these stocks will come in sharply, and you will be left with large losses if you're making mistakes here. That is, the market, a bull market or strong bull market like this is going to forgive your mistakes until it doesn't. And when it doesn't, it's going to punish you hard. So again, it only ends badly if you don't have a plan. Have your plan, have the balls and the discipline to implement it, and have a good weekend. Thanks for tuning in.